Hello everyone. Let us continue with our discussion. So till now what we have discussed is when we are allocating our assets. Okay. So we are allocating based on the asset, based on the liquidity driven, based on the goal driven. Clear? But now I am changing a theme. Okay. Little bit theme is moving towards asset allocation by asset class or the risk factor. Okay. So one thing is clear, when I have to invest my shares, bonds, golds, real estates, or cash, clear, I am going to invest them based on their risk factor. Okay, I'm going to understand the systematic risk factor. So what is systematic risk? Market risk means how that particular asset is getting affected because of the market risk. Clear? Now risk that affects everyone and cannot be avoided, that is your systematic risk, like interest rate changes, inflation, economic recessions, some wars or pandemic. Clear? So each asset class reacts differently to these risks. Clear? So when interest rate will increase, bond price will start falling, or when inflation will increase, gold often perform better, or when the economy will grow, equity will perform well. So each asset class represent exposure to the specific systematic risk. So based on the example which I have given just now, bond price influenced by interest rate, systematic risk; gold influenced by inflation; equity influenced by the economy as well as the GDP. Clear? Now coming towards the strategic asset allocation. Okay, it means I am deciding how much money to put in each asset class, like 50% for the equity, 30% for the bonds, and then going towards 10% for the gold and 10% for the cash. Clear? Now this decision is not random. It reflects something like how much risk the investor can take and what kind of systematic risk exposure I want. Like if I will put most of my money in bonds, that means I am looking for the interest rate risk. But if I'll put most of my money into gold, then I want to cover up the inflation risk. Clear? Are you clear with this? Okay. Now let us take the discussion ahead. Why this asset allocation is important? Three things always comes to my mind. It helps the portfolio manager to monitor the risk, control the risk, and avoid too much dependency on one assets. Clear? So if you put your money into multiple baskets, it's easy to manage your diversification benefit. You can get the benefit of correlation. Risk will get reduced. Clear? So now what I'm going to discuss is the three super asset class. Basically, I'm talking over here about the broad categories. Clear? So the first one we start with is the capital assets. Capital assets, basically the assets which are going to give us the regular income. Like equity will give you the dividends, bond will give you the interest. Okay, it's just like the salary which you receive every month. So I call this as a capital asset. Are you clear? Now, coming to the second one, consumable and transformable asset. Clear? What is this consumable and transformable asset? Asset that can be used up or that can be converted into value, like oil, wheat, copper, commodities, raw material. So you can use them. Clear? Like milk or vegetable. Once used, they are gone. Clear? So either you can use or it can got converted. Then the third one which we have is the store of the value assets, like assets that store value and give money when sold, like gold, currency, some arts, some rare coin. So it's like saving money in a locker but in some different forms. Clear? Why do we need to properly define the asset class? See, because not all assets behave the same way. Clear? Like Indian equities or emerging market equity, both are equity. Indian equity and emerging market equity, they both are equity, but risk is different, returns are different, currency risk is also different. So combining everything into one equity class may hide the real risk. So it's very important that you properly define your asset class, Indian equity or emerging equity. Clear? Now, everyone says, sir, I want to invest my money in the good asset class. So what is the criteria that I can say that yes, this particular asset class is best? The first one is the homogeneity, similar description and statistical characteristics. Like what the asset is, their returns, their volatility, they are almost similar. Like large cap stocks, they behave differently versus the small cap stock. Clear? So they may be a separate subclass, they are the part of the equity, but still they are large cap, small cap and mid cap, still there are subsets. Clear? Then asset should belong to only one class. Like an asset cannot be in two asset class at the same time, otherwise it will create a confusion. Like if gold is sometimes treated as a commodity and sometimes it is treated as a currency, so classification is weak. So if there is a confusion, asset class definition is too vague. Clear? So for an analyst, for an investment, for an investor, it becomes very difficult, because suppose as an investor, I am giving my money to you and you are an analyst, and I say don't invest my money into the currency segment. Clear? So if you classify gold as a currency, will you be able to invest? The answer is no. So proper classification is important. Clear? Asset class should not be highly correlated. High correlation, that means move together. Low correlation means they move differently. Clear? Diversification works only when asset will behave differently. Clear? If the assets are of the same nature, that means what? There is no benefit of diversification. Benefit of diversification only comes when they move differently. Clear? That means low correlation, that means better benefit. Like equity and equity, okay, they will have a high correlation, but equity and bonds, they will have lower correlation. See, I said equity and equity, that means I might be talking about the large cap and small cap, they are the part of the equity, so the behavior almost remains the same. Okay, on an average it remains the same. Then we have is asset class should cover all investable assets. Clear? Like you should have more choices, better diversification, efficient frontier should move up. You remember this one? It should move up. So it gives you higher return at the same level of risk. This is your risk and this is your return. Clear? So asset class should cover all possible investable assets. Why? Because this will give you more choices, better diversification, and efficient frontier will move up because of the lower correlation. Clear? Like if alternative assets like real estates are excluded, then opportunities are missed and your portfolio will not have the benefit of diversification. Fifth point is asset class must have enough liquidity. Liquidity means how easily asset can be bought and sold. So if buying and selling is difficult, okay, and transaction costs are high, then this particular asset class is not ideal for allocation in my portfolio. Like public equity, they are highly liquid, I should use them in my portfolio, but private land, very less liquid. You don't know when you will be able to sell it and what should be the price of it. Are you clear? Are you clear with this? So can we move ahead? Now, there are some commonly and well accepted asset class like domestic equities. We have domestic fixed income, global equity, global fixed income. Now another options we have is the global equity, global fixed income, cash and cash equivalent. This also includes your treasury bills as well, which are for the short term. Okay, alternative investments like real estates, private equity, hedge funds, etc. Clear? Now you can say that, sir, I want to make more subsets like US equity. We have large cap, we have small cap. Global equity, we have US equity versus non-US equity. So if there is too much of granularity, okay, so it will be very hard to construct a optimum portfolio. So what is granularity? The level of subdivision. So how many tiers you will create out of it, like equity, global equity, US equity, or large cap equity. Okay, too much detail. So make the if you are making too many subsets, so it will make your portfolio complex, difficult to optimize, difficult to manage risk. Clear? So strategic asset allocation should focus on broad asset classes. This one, okay, these are the broad asset classes and the big risk difference, not tiny differences. Clear? So if I'll say strategic versus sub asset classes. So strategic asset allocation means focusing on the broad classes like equity and bonds. Sub asset classes are more detailed like US equity versus non US equity. Clear? So as and when you increase the granularity, the differences between the classes will reduce. Diversification benefits will also get reduced. Clear? Though you define them into layers, but diversification benefits keeps on reducing, because between those asset classes like in equity you created US equity, non-US equity, but they are equity, so they behave at least some portion in the same manner, but bond and equity will not behave in the similar fashion. Clear? So now we are considering the risk factor in the asset allocation. Clear? So using the risk factor in asset allocation, we need to understand that and how this approach is related to the traditional asset class approach. So basically what we are doing, traditional versus the modern way. So what we used to do in traditional manner and what we are doing right now, it's like a comparison. Clear? So let us first of all understand that what we call it as asset based asset allocation traditionally. So we choose asset class like equity, bonds, cash and real estate, and then we decide how much money to put in each of the class. Clear? So this was the traditional method, but now the modern portfolio theory, that is your mean variance optimization, it uses your expected return, it uses your volatility, it also uses your correlation. Clear? So what was the problem with asset class based approach? Now comes the real key problem, that asset classes are not independent. Okay, they often share some of the risk factors like interest rate and inflation. So they both of them are going to impact your bonds, they both are going to impact your gold as well. Clear? So how you are going to manage that inside your portfolio means, this is my portfolio which has both gold as well as bond, and they both are getting affected by inflation and interest rates. Clear? That means what, you have huge amount of risk in your portfolio because of these factors. So we have volatilities, we have liquidity, we have duration, we have foreign exchange, we have default risk, all these are there. So sometimes what happen, your risk factor will overlap. Like I'll give you one example, we have domestic equity. Okay, we have domestic equity and we have domestic bonds. Clear? They both are different asset class, but they both get affected by liquidity risk in the market, volatility risk in the market and foreign exchange risk. Clear? So even domestic companies are getting affected by currency change. Why? Because the imports will become costly or exports will become cheaper, profits will change, stock price will change, bond repayment ability will change. So although we can call them different asset class, but their risk drivers are actually overlapping each other. So why they should matter? Because asset class may look different, but they are behaving in a similar fashion during the bad time. So during the crisis, stocks will fall, bond may also fall, correlation will increase. By examining the risk factor overlap, the investor can better understand the correlation. They can understand the true diversification as well. So they are saying that don't like look them as equity and bond, map them with the risk factors, and now see that what are those risk factors in your portfolio are actually there with the other assets, like the example which I have given you. Clear? So rather than keeping 40% and 60%, I will say they both are same, and I'll say 50% of this, remaining 50% I will get add from the gold. Are you clear? Okay, so if we look at from our notes, so we have completed this common risk factors. Okay, now why to consider the risk factors? So basically they help us to identify the hidden correlation between the different asset class. So this will improve the understanding what truly drives the portfolio risk. It's not the asset class, it's the risk factor which are actually deriving those risks. And it also reveals whether the diversification is real or just superficial. Superficial means, you know, that if my portfolio will have domestic equity and domestic bonds, that means it's not going to be any diversification benefit because most of the risk factors are almost similar. Clear? Then factor based asset allocation, it focuses directly on the risk factors rather than the asset class. Okay, so it uses the multi-factor models to examine the exposure to each factor, like equity, what are those factors it is going to impact, bonds, what are those factors it is going to impact. So what I'm doing, I'm trying to understand all of those factors which are actually impacting my portfolio. Clear? So we have studied that APT models. Okay, like this we will create multi-factor models. Clear? Now systematic risk is the one which cannot be diversified away, so I'm going to leave that. I'm just going to consider those factors which are going to impact my portfolio separately other than the factor of systematic risk. Clear? Builds factors portfolio that isolate the systematic risk, so you don't want to consider those. Now we have factor based asset allocation. So it's better that you will allocate your portfolio which covers all the factor risk. Clear? So basically a factor portfolio is designed to capture only one factor risk. So right now what I was doing, I am creating say 4 portfolios, or you can say a portfolio with 4 different assets: equity, gold, then we have bonds, and say currency. But now I'm not making my portfolio like this. Now what I'm doing, I have 4 factors: inflation, interest rate, currency risk, and GDP. I'll put 40% of my portfolio on this, 30 on this, 20 on this, and say 10 on this. Are you clear? So I'll put my investment based on the risk factors rather than on the asset class. Now the question is this good? See, nothing is perfect. Everything have their own limitations. Okay, so when it comes to the limitations, now some risk factors are not directly investable, where you cannot invest directly. Some are very hard to measure or find out the exact exposure, complex to implement, require derivatives or short selling. So risk factor analysis is not inherently superior, but it gives some additional insight. So you cannot fully focus on that. What you can do, you can consider that. Okay, that was the suggestion, because it's very hard to implement. Okay, sometimes you require derivatives, sometimes short selling, sometimes you cannot even accurately measure its impact. Suppose liquidity risk impact on bonds or the equity. Clear? So it's very hard to. Now there are many investors, okay, they want risk premium, because if you are taking some extra risk, definitely you want some extra risk premium. Clear? So many risk factors are also linked to extra risk premium, just like the beta. Okay, we have the beta. Clear? So that is also a risk factor. Clear? So I'll say that I'll put my 10% portfolio on the beta, like credit risk, higher yield. Illiquidity will give you higher return. Volatility risk will compensate you for that, that will give you higher return. So if suppose you are an investor and now you have that curiosity, sir, how to invest in the risk factor? The first method is spread position, basically the difference between two position. It involves buy as well as sell. So you will have the long position, you will also have the short position. So suppose you want to isolate the inflation risk. So what you will do, you will go long, you will buy treasury bonds. Clear? And you will sell inflation linked bonds, inflation linked bonds, because this will pay you 7% and this will pay you 7 plus inflation. So what you are left with, 7 minus 7 plus inflation, you are left with inflation only. Are you clear? What you are left with is inflation. Clear? Second is your volatility risk. Suppose you want to invest in the volatility. Clear? Investors can invest directly in the VIX futures. In many countries, you will see that VIX futures are getting traded. We call this as a volatility index. So payoff depends upon the movement in the volatility. Are you clear? So there are different methods by which you can actually trade into those risk factors. So now if you'll ask me the relationship between the asset class and the factor based approach, means one is saying don't invest in the factor versus invest in the asset, or another one is saying invest in the factor. So asset class based approach is very simple, very intuitive, very easy to implement, but hides the overlapping risk. When it comes to the factor based approach, they are more precise. You can control the risk of your portfolio. You will have better understanding of the correlation, but it's more complex and not all factors are investable. Clear? So investors often use both approaches together. Now, coming towards the last portion for this particular lecture, that is your strategic asset allocation. Clear? We have introduced it in the beginning, like one of the most important topic when you talk about the portfolio management and the allocation of the assets. Clear? So what this strategic asset allocation is? It's first of all, it's a long term plan. It's a long term plan which will decide how much money to invest in each asset class based on market expectations, investors objectives, and investors constraints. These are the three things to be kept in mind: market expectations, objective of the investors, and constraints of the investors. And it is not a short term trading. Clear? So you can put it down over here. It is not a short term trading. This is not a short term trading. So what inputs are used over here? Strategic asset allocation combine two big things. Okay, what are those two big things? One is your capital market expectations. One is your capital market expectations. Clear? And second is your investors information, that is your IPS. So they look at both perspective about the market, about the investors. So when I'm talking about the capital market expectation, so I consider expected returns, volatility and correlation. And when I consider IPS, I'm going to consider the risk tolerance, return requirements, constraints, legal, time, tax, everything. Clear? So it's like I'm designing my diet. So I look at the food nutrients. Also, I look at the investor constraints like their age, health goals, as well as the allergies. Clear? Now, it's a long-term nature of the strategic asset allocation. Clear? So, over here, asset weights, how much I'm going to put in that particular given asset is known as a target weights. Clear? Now, the resulting portfolio is known as policy portfolio, target portfolio, or benchmark portfolio. So, this is the base plan of the investors. Clear? Now, we have one more point, utility theory basis. Now, the point which I have in my mind when I am going to invest. Okay, see, I'm till now what I'm talking about return and the risk. It is coming from the theory, utility theory. That means satisfaction and happiness which I get from the wealth. Second is your risk aversion, that how much an investor dislike the risk. Clear? Because we also need to consider that as well when I'm allocating a portfolio. Clear? So how you are going to measure the utility, how that utility is measured? Expected utility depends upon multiple factors like distribution of ending wealth. Okay, how you distribute your wealth, asset class weights, asset class return, beginning wealth. Like if two investors, they both will earn 10%, but one prefer the stable return and another one will like the risky return, then utility theory captures this difference and accordingly it is going to define your portfolio. Clear? Where the purpose is to maximize the utility. Clear? So when I talk about optimal asset allocation, what I want, maximize the utility subject to the constraint. Constraint will always remain the part of your portfolio management. So the allocation that gives maximum utility over the investment horizon is the optimal asset allocation. Write down the allocation, the allocation that gives, the allocation that gives, the allocation that gives, the allocation that gives The allocation that gives maximum utility over the investment horizon is the optimal asset allocation. Okay. Now, steps to select and justify the strategic asset allocation. So we have moved from the allocation to the steps that, yes sir, if I'll follow this step, the asset allocation will consider to be the strategic. So first, what I have to do, determine the investor's objective. Again, means we are coming towards the IPS. Clear? Second, determine their risk tolerance, how much risk they can actually take. Then understand the time horizon. So these points are repeated again, their constraints. And then select the asset allocation approach, whether you can go for asset only, liability relative, or goal based. Specify the asset classes. Okay, which class you are going to invest in. Clear? Then step 7 is develop the potential asset allocations. Okay, over here you have to optimize the methods, like multiple asset allocation combination are required. Each has different risk and return trade-off. So what you will do, you will have multiple options. Clear? One option you have created, say equity and bonds 60/40. You created equity, bond, gold, say 40/30, and then say 30. Then you created another options like this. Now you will see which asset allocation combination is best based on the IPS. Clear? That is important. Now, once you have generated all possible outcomes, so what you will do, you simulate and you test the results. Okay, testing that what could happen in the future with each of the possible options. Clear? So do result meets return objective? Is the risk acceptable? Does it work over the chosen time period or not? Clear? Now you have to repeat it again and again until you will find your optimal allocation. Clear? Now if the results are not suitable, go back, adjust the weights, test it again. So this will continue until the best allocation of your funds is found to you. Clear? So now once you will define your portfolio, now what you have to do, you have to regularly monitor it as stated in the IPS. Monitoring will include your performance reviews, risk review, and market condition reviews. Clear? And it will go towards a feedback loop, means learn from the outcomes, update the assumptions. So if like if the long term market changes occur, then revise your strategic allocation. Short term market change occurs, then use some tactical allocation, that too for the short time. So what is this strategic versus tactical allocation? Strategic allocation is always for the long term. Tactical allocation is like making the short term adjustments, like you know that market condition is not good, so strategic equity level is 60, temporarily you will move it to 55. Why? Because of the market condition, you don't want to hurt your portfolio's return in any manner. Clear? So we have completed, I think, LOS till G. Clear? In the next lecture we'll move ahead with the another set of lectures. Okay, thank you.